People really don't know what their expenses will be because they don't know how long that they're going to live.
Americans are worried they won't have enough saved for retirement now more than ever.
Retirement is going to cost, for many folks, over $1 million.
Is no sure thing in investing, but a lot of people think that annuities may come close to that.
It's going to more safe things that they know. If they know they're going to need that money to supplement their retirement, well, then you can't play that risk.
This is the Safe Money and Retirement Show with Jon Heischman Sr., founder and partner of Heischman Financial Services, serving the Columbus and surrounding areas. Jon specializes in educating pre-retirees and retirees about safe money strategies and ideas. Now, it's the Safe Money and Retirement Show. Here's Jon Heischman Sr.
In the midst of grief over a spouse's death, the greatest comfort may be knowing that the two of you planned for this and the remaining spouse will be comfortable financially. I want to talk about this on today's show. Welcome. This is your host, Jon Heischman, on the Safe Money and Retirement Show. Too many times, a retirement plan stops at the death of the first spouse, especially when we're talking about income. In my opinion, a retirement plan has to continue, and plans for the continuation of income to the surviving spouse, whether it's 100% or a reduced amount. And this all depends on each individual situation and their needs. Nobody wants to think about what would happen if their spouse passed away. But the fact is, very few couples die at the same time. In 80% of the cases, the wife will outlive the husband, and this is according to the Census Bureau. So it's particularly important that they are comfortable about their ability to live comfortably in that event. So creating a plan, the two need to have important documents, including a will, power of attorney, healthcare directives, and powers of attorney updated. Consolidate accounts as much as possible to simplify the management that is involved faced with this situation. Prepare the likely survivor's penalty after the death of a spouse when Social Security income is cut and tax rates often double. When I put together a plan and the client is married with the spouse, it's mandatory that the income plan is going to continue. For what percent, as I mentioned earlier, that depends on a lot of factors. And one of the big ones is, if there's a pension plan, how much of that pension income is going to continue to the surviving spouse? Social Security is a big part of it. If your Social Security was the lower payment, you'll need to file to start receiving your spouse's benefit. The surviving spouse will only receive a single benefit from now on, which can have a big impact on finances. If the couple was used to getting, let's say, $30,000 from one benefit and $25,000 from the other, for example, the remaining spouse will only receive $30,000 instead of $55,000. That's a pretty big drop if they're dependent on that type of income for living expenses. Is there a plan to make up that difference? for the surviving spouse. There needs to be. If not, it's a shock, it's an adjustment, and it can drain retirement assets. Over the next couple of days, take a look at your plan. Think about what I'm discussing in today's show. If your plan is not going to continue, or you suspect there's going to be a drop in income at the death of one of the spouses, give me a call. I can show you different ideas, strategies that can solve the problem. Too many times it's overlooked, and planners have not taken that extra step as far as income continuation. My number is 614-861-7055. I'll give that to you again, 614-861-7055. There is no cost and absolutely no obligation, no selling. It's strictly a review and ideas and educate as to how to solve the problem. Another potential problem is taxes. The year that a spouse dies, the remaining spouse can still file taxes jointly with their deceased spouse unless they've remarried. After that, they'll most likely be using the single filing tax status, which includes a standard deduction for only one person and tax brackets that are half of their previous filing status. And this, of course, can be quite a shock, as your taxes may double even if your income is relatively stable. We have to allow for that. Once again, it's overlooked many times simply because the planning was done for the client and it didn't continue into a death situation for the surviving spouse. Most of the time, a surviving spouse inherits their deceased spouse IRA and required minimum distributions. They're going to stay about the same as before. But here, too, the new single tax brackets can heavily impact taxes due the following year. In 2024, for example, a couple with a taxable income, I'll use $94,000, would pay up to 12% in taxes, while a single filer making that amount would be taxed at 22% marginal rate. That can add up to a lot of money. It needs to be addressed in the retirement plan. One way to minimize these impacts is to do partial Roth IRA conversions. When IRA funds are converted, taxes are paid in that year for only the amount converted. It's important to work with a planner and or a CPA or tax professional to make sure the strategy works with your overall retirement plan and in your best interest. Another thing I want to look at is investors need to keep their asset ownership updated, especially on highly appreciated assets. The basis of an asset is simply the original cost. So when a spouse dies, the remaining spouse receives what we call a step up in basis, changing the basis to the value of the asset when the spouse died. This can wipe out months or years of capital gains, which would otherwise be owed when the asset was sold. Once again, it's overlooked many times. It's not taken into consideration. And of course, and as always, each person's situation is different, depending on how much money would apply. If you missed a step-up opportunity, this could mean higher capital gain taxes for the surviving spouse. Losing a spouse, I'm sure, is a devastating event. Prepare your finances ahead of time so it's one less thing the surviving spouse has to deal with when they are in their most vulnerable situation. And of course, often the best way to do this is to use a trusted financial advisor, estate planner, or a retirement planner. So again, think about your situation as to will your income continue, or what portion of your income will continue to the surviving spouse. I never want to be, and I never have been in a situation where I have to go back to a surviving spouse and let them know that your income is now going to drop, let's say 50%. Because when that situation occurs, and it does, the surviving spouse was totally unaware of that situation, and proper continuing planning was not done. If I can help you in correcting that problem, or at least pointing out that there is a problem, let me know, and we can schedule a time to review your continuation plan. 614-861-7055. Again, 614-861-7055. I'm going to take a short break at this time, but stay with me. I'll be right back.
Thanks for listening to the Safe Money and Retirement Show with Jon Heischman. For more information, call 1-888-426-0177. That's 1-888-426-0177. Or visit their website at HeischmanFS.com. More of the Safe Money and Retirement Show in a moment.
Life expectancy is at all-time highs, so that means you've got a future to plan for at any age. If you have longevity in your family tree, then you need financial education from someone with the experience and knowledge to guide you into and through your retirement years. Jon Heischman and the folks at Heischman Financial Services are committed to helping you achieve your retirement goals with a low-key and trustworthy approach. Call Heischman Financial Services today to get started on your retirement future. Call 1-888-426-0177. That's 1-888-426-0177. Heischman Financial Services has your future in mind.
Welcome back to the Safe Money and Retirement Show with Jon Heischman. To contact Jon, the number to call is 1-888-426-0177. That's 1-888-426-0177. Once again, here's Jon Heischman.
Welcome back to the Safe Money and Retirement Show. I'm Jon Heischman. I want to spend the remaining time that I have this morning and talk about the baby boomer generation, IRAs, 401ks, pension plans, any other qualified accounts that apply. And of course, I think everybody knows that the baby boomer generation are those born between 1946 and 1964, as their parents would remember World War II or the Korean conflict and the grooming of Frank Sinatra. Boomers are more likely to be tuned into Vietnam, the Beatles, Woodstock, and electronic gadgets their parents never dreamed of owning. This generation is close to 78 million strong, and anyone who sells anything has been targeting this generation for as long as the expression baby boomer has been around. To give you an idea of how large this generation is, there is approximately 10,000 boomers reaching retirement age every day, therefore control the majority of the wealth of America. How well this generation manages their money is of enormous importance to everyone. Not only has this generation been contributing to 401k account, IRAs, etc., they have and will receive inherited money from their parents. In addition to receiving their parents' IRA accounts that still had assets accumulating, which creates the need for detailed and advanced planning. Most boomers will have at least one, if not several, qualified retirement accounts, again, an IRA or 401k. If you're a boomer, you are part of the group with the highest probability of having your own IRA, 401k, SEP, TSP, and also inheriting IRAs and 401ks from your parents. The IRA you own will need to be treated differently from the IRA you may inherit. The distribution rules, they're different from your personal IRA versus an inherited IRA. Because of this, the distribution mistakes can easily lead to costly IRS tax traps. And that's why I sponsor a book entitled Top 10 IRA Mistakes: How to Avoid IRA Tax Traps. It's an easy read, 98 pages, and I would love to have all of my listeners have a copy. When you order this book, it will come from my office. There will not be a cost, and there's no obligation for requesting the book. After you read the book, if you'd like to schedule a meeting with me, feel free to do so. So to request the book, please call 614-861-7055, and it will be in the mail within the next day. 614-861-7055. And one more thing, visit our website. There's a lot of good information, as well as past radio shows and podcasts. HeischmanFS.com. I'll spell that for you. HEIschmanFS.com. Over the years, most boomers have made substantial contributions to their IRAs, 401ks, TSP plans, 403bs during their years in the workforce. Some may also have benefited from employer matching funds and have grown their retirement account into a substantial nest egg. Now, here's the thing. The rules for the plans you contributed to are the same as the rules for your parents. Over these years, you have paid no income tax and take advantage of the tax deferral and write-off that these plans have allowed you to do. So here's where it gets complicated. In addition to the IRA you own, as mentioned before, you're likely to inherit a retirement account from one or both of your parents. Having these two different types of accounts can create income and distribution challenges. The distribution rules are substantially different from an IRA you own versus an inherited IRA that you're going to or have received from your parents. In addition, your beneficiary is going to be faced with decisions that will need to be made quickly. When you get into the combination of your own IRAs and inherited IRAs, you're creating the potential for mistakes, and I'm referring to tax mistakes. Also, you're going to be in a situation where you have to decide when it comes to taking retirement income, which accounts are you going to draw from first? Which do you delay? Inherited accounts, you may not have a choice depending on where the money came from. Your IRA can delay distributions until age 73. So when putting together an income plan, I have to look at all of these accounts. Where did the money come from? And how is the distribution from those accounts going to fit into your income? And please don't think this is complicated, because it does sound complicated. It's really not, especially for someone like me that's been doing this for many, many years. I make it simple to understand and make sure it is in your best interest. There's also the decision as to where this money is going to be placed in the interest of growth, taxes, and guaranteed sources of income that you can't outlive. The money that is involved from this generation is in the trillions of dollars of qualified retirement money in America. Now, this is big business, and every potential company wants to manage your money and to have you put your money with their company. Everyone is going to be ready to give you advice, but not all are skilled in the distribution rules. It's one thing to manage and grow your money. It's a whole nother game when it comes to distribution. Acting on the wrong advice could lead to one of the many IRS tax traps. So if you're armed with the right information, you'll know who is giving sound financial advice and who to send packing. And that's why the book, Top 10 IRA Mistakes, How to Avoid IRA Tax Traps, is so important. Or maybe you don't want the book, but you would like to schedule a time to meet with me, either over the phone or in person, whatever works out best for you, because I want to make sure you're making the right decisions. It's that important. 614-861-7055. Once again, 614-861-7055. As with all of my shows, I hope you have learned important information today and how it can apply to your retirement planning. I'm Jon Heischman, your host of the Safe Money and Retirement Show, and tune in next week for new information on retirement planning.
The Safe Money and Retirement Show with Jon Heischman Sr. To get in touch with Jon, call 1-888-426-0177. That's 1-888-426-0177. For more information about Heischman Financial Services, visit their website, HeischmanFS.com. That's HeischmanFS.com. Join us again next time for the Safe Money and Retirement Show with Jon Heischman Sr.